What if the banking collapse you fear is not something in the distant future, but something already unfolding beneath your feet, hidden behind reports, political speeches, and economic forecasts that sound reassuring on the surface but tremble underneath? What if the same sequence that destroyed financial systems in past superpowers is happening again, step by step, inside nations once considered unshakable? The disturbing reality is that the United Kingdom, Germany, and Canada are no longer approaching the danger zone. They are already standing inside stage 6, the critical phase where liquidity fractures, confidence evaporates, and the system begins feeding on its own instability. And if you look closely at the numbers, the behavior of central banks, and the defensive posture of global institutions, you start to notice the same structural pattern repeating with chilling precision. Stage 6 is the point where the tide turns silently, when the cracks that used to be subtle become deep, enough to reshape everything built on top of them. Liquidity mismatches start accelerating. Interbank trust begins to thin out. Large institutions quietly prepare contingency plans. Regulators insist everything is fine, not because it is, but because the slightest admission of fragility could trigger an irreversible chain reaction. You can trace this pattern across centuries. Before collapses in Spain, Britain, the Soviet bloc, and the global crises of 2008 and 2020, the same emotional and structural signals appeared. First denial, then forced optimism, then frantic interventions, and finally the moment when the public realizes the truth too late. The banking system today mirrors those moments with unnerving similarity. And while most people still believe that wealthy nations with strong currencies are somehow insulated, history shows that financial systems do not collapse from poverty, but from overconfidence, excessive leverage, and dependency on artificial liquidity. When a system reaches stage 6, contagion becomes unavoidable because it is no longer about one failing institution. It is about a network losing its ability to absorb shocks. That is what makes this moment so dangerous, and why understanding this pattern is no longer a matter of curiosity, but survival. You already know how it starts. What you do not know yet is how quickly the final phases unfold once the internal pressure reaches its limit, and that is exactly where this story continues next. Before we move forward, share your thoughts in the comments and tell me if you have ever felt that something in the global banking system just does not add up. Your opinion matters and helps keep this conversation alive. And while you are here, make sure to like this video and check if you are already subscribed, because what comes next will give you an even deeper understanding of this pattern as it unfolds in real time. As the cracks inside stage 6 deepen, the most revealing signals are not the dramatic ones governments rush to explain away, but the quiet structural shifts that most people overlook. The expansion of credit is one of these signals, not because lending itself is inherently dangerous, but because of how it grows when a financial system begins detaching from the real economy. In stable cycles, credit expands because productivity rises, incomes increase, and people borrow to build something tangible. But in late-stage cycles, credit expands to cover structural weaknesses, to disguise stagnation, to create the illusion of growth where none exists. That is exactly what has been unfolding across the banking systems of the United Kingdom, Germany, and Canada for more than a decade. The deeper the disconnect becomes, the more banks rely on financial engineering rather than genuine economic momentum. You start to see lending that inflates asset values instead of supporting productive industries. Housing markets rise far beyond wage growth. Corporate bonds are issued, not to innovate, but to refinance older obligations. Consumers borrow not for opportunities, but to survive inflation, shrinking purchasing power, and rising living costs. This kind of credit expansion is a quiet warning that the system is extending itself into fragile territory, building a scaffold that looks solid from the outside, but is hollow at its core. What makes this shift even more dangerous is that governments and central banks often interpret it as a sign of strength. They see rising credit activity and conclude that confidence is holding, when in reality the financial system is compensating for deeper imbalances. Liquidity is pumped into the economy to maintain appearances. Low interest rates encourage borrowing. Asset bubbles grow because they must, because the alternative is exposing the underlying weakness. And each new layer of debt pushes the banking system further away from the real economy it is supposed to reflect, creating a gap that becomes increasingly impossible to close without severe consequences. This widening disconnect creates a cycle where the system becomes dependent on credit injections simply to maintain stability. Banks begin competing for yield, taking positions they would never consider in a healthier environment. Governments celebrate temporary boosts in GDP without acknowledging that the growth is synthetic, inflated by leverage rather than productivity. Over time, these distortions reshape the entire economic landscape until it becomes difficult to distinguish genuine value from artificially engineered expansion. That is how Stage 6 strengthens its grip. not with sudden collapses, but with a slow tightening of conditions that quietly shift the center of gravity away from fundamentals. And as that gap widens, the system becomes more vulnerable to shocks that once would have been insignificant, setting the stage for everything that follows next. As the banking system drifts further from real economic foundations, another force begins shaping the trajectory of collapse. The chain reaction triggered by monetary policies that were never designed to operate inside an already over-leveraged environment. When central banks step in with rate cuts, liquidity injections, and emergency tools, the intention is to stabilize, but in late-stage cycles, those same interventions create structural dependency, encouraging banks to take risks they would never touch under normal conditions. This is where the pattern becomes unmistakable, because once the system begins leaning on artificial liquidity for survival, every adjustment becomes a potential trigger. For the United Kingdom, Germany, and Canada, this is not theoretical. Years of ultra-low interest rates created an ecosystem where borrowing was cheap, leverage was rewarded, and risk was systematically redefined as opportunity. Banks expanded their balance sheets, not because the economy demanded it, but because the monetary environment practically forced them to. When money is nearly free, institutions stretch for yield, and that stretch reshapes the entire architecture of financial stability. Mortgages grow faster than incomes, corporations roll debt forward with no intention of reducing it, and government spending expands under the assumption that liquidity will always be available. But monetary support has a dark side. The longer it persists, the more distorted incentives become. Banks begin treating liquidity buffers as permanent safety nets rather than temporary tools. Governments grow comfortable relying on centralized interventions to correct market stress. And investors, observing the cycle repeat, start to believe that downturns will always be softened by rapid policy action. This false sense of protection pushes capital into increasingly speculative corners, tightening the interdependence between policy decisions and market reactions. When central banks finally attempt to reverse course, the fragility becomes visible. Raising rates exposes the vulnerabilities that accumulated during years of easy money. Banks holding long-term assets suddenly face losses. Highly leveraged borrowers struggle under the new cost of debt. Real estate markets, once artificially inflated, freeze as affordability collapses. And every sector that expanded because money was cheap faces a recalibration it cannot endure. This is where monetary dependence turns into systemic vulnerability. Worse yet, each correction amplifies the next. A minor policy change sends shockwaves through sectors that relied on predictability. Banks react defensively, tightening lending standards not out of caution, but out of necessity. Companies dependent on refinancing start failing quietly at first, then in clusters. Consumers feel the pressure through rising costs, shrinking credit access, and stagnant wages. The entire system begins to resemble a network of dominoes arranged so tightly that the fall of one accelerates the fall of the next. What emerges from this environment is a financial system that no longer responds to fundamentals, but to survival instincts. And with every adjustment, every intervention, and every unintended consequence, Stage 6 moves closer to solidifying its grip on global banking, preparing the conditions for the next escalation that will not be so quiet. As monetary dependence deepens and the system moves further away from stability, the next turning point emerges in a place most people overlook: public confidence. Banking. Systems do not collapse simply because of numbers on balance sheets. They collapse when trust erodes, when people begin questioning whether their deposits, their savings, their pensions, and their institutions are as secure as they have always been told. This erosion rarely begins with panic. It starts quietly, with subtle shifts in behavior that signal a deeper psychological break between the public and the financial system meant to protect them. In the United Kingdom, Germany, and Canada, these signals have been appearing for years. You see depositors quietly moving funds from smaller regional banks to larger institutions they perceive as safer. You see families redirecting their savings into assets that feel more tangible, more resistant to decay, even if those choices come with higher risks. You see businesses hesitating to commit long-term capital, not because opportunities disappeared, but because uncertainty has become a constant shadow over every financial decision. These small movements don't make headlines, but they reveal something fundamental. Trust is no longer taken for granted. As confidence thins, banks begin adjusting their posture long before the public realizes what is happening. They tighten lending standards, not as a strategic choice, but as a defensive reaction. They reduce exposure to sectors that once seemed stable. They quietly restructure portfolios, reposition liquidity, and increase internal stress testing. These actions signal that institutions no longer see the environment as predictable. And when banks behave cautiously, the market interprets it as weakness, which then accelerates withdrawal behaviors that deepen the very fragility everyone hoped to avoid. This feedback loop is one of the most dangerous elements of Stage 6. Trust becomes volatile. Depositors move money preemptively, investors behave nervously. Politicians attempt reassurance, but their words often sound disconnected from the underlying reality. Every announcement, every policy decision, every unexpected shift is interpreted through a lens of suspicion. Even rumors, those unverified whispers that once would have been dismissed, gain power in an atmosphere already saturated with uncertainty. At this point, the banking system begins to feel like a glass structure under pressure. Not broken, not yet, but one sharp impact away from revealing how thin the surface has become. This fragility becomes visible in liquidity patterns, in the sudden hesitations of markets, in cross-border capital movements that react to perceived threats faster than regulators can respond. And as the public slowly recognizes these signals, the psychological shift accelerates, reshaping the emotional landscape that determines whether people stay calm or start preparing for something more serious. Trust, once lost, does not return easily. And in systems built on leverage, liquidity, and confidence, that loss marks a turning point that cannot be ignored. As confidence erodes and institutions brace themselves, another force quietly tightens around the banking system, shaping its final trajectory: hyperfinancialization. This is the moment when the financial sector becomes so large, so interconnected, and so dependent on complex instruments that it no longer resembles a support structure for the real economy. Instead, it becomes an ecosystem feeding on itself, creating layers of abstraction so intricate that even the institutions responsible for them struggle to measure the risks they carry. What began decades ago as an effort to increase efficiency and liquidity has now become a vulnerability capable of destabilizing entire nations. In countries like the United Kingdom, Germany, and Canada, this hyperfinancialization did not happen overnight. It evolved gradually, hidden behind innovations that appeared beneficial at first. Financial products became more sophisticated. Derivatives expanded far beyond their original purpose: shadow banking. Systems emerged in the spaces regulators failed to monitor. Pension funds, insurance companies, and investment firms all became interconnected through chains of obligations that were never designed to withstand prolonged stress. The economy grew increasingly dependent on these layers, relying on them not just for investment, but for basic stability. As these structures expanded, a silent shift occurred. Banks and financial institutions began prioritizing speculative gains over traditional lending. They discovered that profits were greater when tied to financial engineering than when tied to productive growth. Returns from housing bubbles, credit markets, leveraged bonds, and complex asset structures overshadowed returns from supporting industries, innovation, or long-term economic development. This change transformed banks into entities that thrive in periods of expansion, but become dangerously exposed in periods of tightening. The consequence is a system where vulnerability is built into its foundation. When markets are booming, hyperfinancialization appears efficient. It amplifies liquidity, accelerates growth, and inflates asset values that governments and institutions quickly learn to depend on. But when the cycle shifts, the very same mechanisms turn against the system. Liquidity evaporates at speeds regulators cannot keep up with. Institutions holding long-term assets face immediate losses. Leverage, once an engine of growth, becomes a trap that magnifies every shock. This dynamic is particularly dangerous because it blurs the line between real value and artificial expansion. The financial system begins to behave as though rising asset prices represent economic strength, even when wages stagnate, productivity slows, and household debt climbs. Governments, too, become entangled, depending on these inflated valuations to support public spending, pensions, and fiscal stability. The illusion is powerful, but illusions do not survive stress. As hyperfinancialization deepens, banks become structurally incapable of absorbing losses without triggering wider contagion. A failure in one corner of the system, whether in real estate, corporate bonds, or derivatives, spreads rapidly across borders and sectors. The architecture that once promised resilience now acts as a transmission network for instability, allowing local problems to escalate into global crises with alarming speed. And with each passing year, this vulnerability grows, tightening the cycle and pushing the system closer to the point where the next shock will no longer be contained, but amplified far beyond what traditional safeguards can manage. As hyperfinancialization tightens its hold on the global system, another critical transformation begins to unfold behind the scenes: the weakening of central banks themselves. For decades, these institutions were treated as the ultimate stabilizing force, capable of absorbing shocks, guiding markets, and restoring balance whenever the financial structure trembled. But once a system reaches stage 6, the relationship reverses. Instead of central banks controlling liquidity, liquidity begins controlling central banks, pushing them into a reactive posture where every decision carries unintended consequences that ripple across the world. The shift becomes clear when you examine recent years in the United Kingdom, Germany, and Canada. Their central banks, once confident in their models and projections, increasingly face conditions they did not anticipate and tools that no longer behave as intended. Rate hikes designed to curb inflation expose hidden weaknesses in banking portfolios. Attempts to reduce balance sheets send shockwaves through housing markets. Liquidity injections meant to calm volatility instead fuel new distortions that require even more intervention later. The cycle becomes self-reinforcing, not because policymakers lack experience, but because the system has reached a point where every lever is connected to a deeper structural imbalance. The problem is not simply that central banks are making difficult decisions. It is that they are trapped. When inflation rises, tightening is necessary, but tightening destabilizes banks that relied on years of easy money. When growth slows, easing becomes necessary, but easing inflates the very bubbles that threaten long-term stability. Each move corrects one imbalance while worsening another, revealing a system so stretched that no policy option is safe. Central banks can either act and trigger turbulence or remain still and allow deeper vulnerabilities to spread unchecked. For Germany, the pressure is visible in the cracks within its industrial sector, which can no longer rely on predictable financing costs. For the United Kingdom, the bond market has become increasingly sensitive to small policy missteps, signaling a loss of confidence in long-term fiscal direction. For Canada, the housing market, one of the most inflated in the developed world, has become a risk center that forces the central bank to choose between protecting households or preserving financial stability. In each case, liquidity behaves differently than expected, reacting violently to adjustments that once would have been routine. What makes stage 6 especially dangerous is that the psychological power of central banks begins to fade. Markets no longer interpret their actions as signs of guidance, but as signs of distress. When a central bank steps in, rapidly, investors wonder what hidden danger triggered the move. When it hesitates, speculation intensifies. When it issues warnings, confidence reacts negatively. The authority that once anchored the system weakens, and uncertainty fills the space left behind. This erosion is subtle at first, noticeable only through abnormal market behaviors, short-term volatility spikes, sudden liquidity shortages, unexpected correlations between asset classes. But over time, these signals accumulate, revealing a profound shift. Central banks are no longer steering the system. They are holding onto it, trying to slow a momentum that has already gained too much speed. And as this disconnect widens, the system enters a phase where the appearance of stability can collapse quickly, setting the stage for the moment when the illusion of control finally breaks. As the authority of central banks weakens and the system becomes increasingly reactive, one of the most revealing shifts appears in the failure of the safeguards that were supposed to prevent crises. Stress tests, regulatory frameworks, liquidity coverage ratios, capital buffers. These mechanisms were designed to project an image of resilience. For years, they reassured the public that even if markets trembled, the core of the banking system would remain stable. But in stage 6, these protections reveal themselves for what they truly are: simulations built for conditions that no longer exist. In the United Kingdom, Germany, and Canada, the cracks in this protective architecture are becoming obvious. Regulations created after 2008 were modeled on assumptions that markets would react within predictable ranges, that interest rate cycles would remain gradual, and that liquidity would behave according to historical norms. None of these assumptions hold anymore. Markets have become more highly leveraged, more interconnected, and more sensitive to small shocks. A system this complex cannot be stabilized with tools designed for a different era. Stress tests, once presented as proof of safety, demonstrate this gap clearly. Banks pass the tests, yet when confronted with real-world volatility, their balance sheets strain under pressures that the models cannot replicate. Hedging strategies that were expected to reduce risk instead amplify it under rapid rate movements. Contingency plans rely on liquidity that disappears at the first sign of stress. Regulators insist that institutions are well capitalized, but capital means little when the value of assets and collateral shifts faster than they can be measured. This illusion of safety is one of the most dangerous aspects of the current stage. It creates a false sense of confidence, convincing both policymakers and the public that the system is protected when, in reality, the safeguards are only effective under stable conditions. Once volatility becomes structural, not temporary, every guarantee weakens. Deposit insurance becomes a psychological tool rather than a realistic promise. Liquidity backstops depend on market functioning that cannot be taken for granted. The entire safety net begins to resemble a thin layer stretched across a growing void. Inside the institutions, executives understand this vulnerability even if it is never stated openly. Internal reports grow more cautious. Scenario analyses become more alarming. Risk departments warn that exposures are widening beyond acceptable thresholds. But because acknowledging these weaknesses publicly would trigger panic, the system continues forward, relying on confidence that no longer reflects the underlying reality. This creates a widening gap between what people believe is happening and and what institutions know is unfolding behind closed doors. And it is within this gap between perception and reality that stage 6 solidifies, a thin shield of simulated stability covering a foundation that is already shifting, waiting only for the right external shock to reveal how fragile the structure has become. As the illusion of safety weakens and regulatory protections reveal their limitations, another destabilizing force rises to the surface: the convergence between public debt, private debt, and the fragility of the banking sector. In earlier stages of financial cycles, these three domains operate with some degree of separation. Governments manage fiscal pressures, corporations handle their financing needs, and banks navigate their own balance sheets. But in stage 6, the boundaries dissolve. Each strain feeds the next, creating a unified system where the weakness of one becomes the weakness of all. This convergence is especially visible in the United Kingdom, Germany, and Canada, where rising sovereign debt intersects with private sector leverage in ways that would have been unthinkable a generation ago. Governments have accumulated unprecedented obligations, not gradually, but through a series of crises that demanded rapid fiscal expansion, global recessions, pandemics, energy shocks, and systemic bailouts. To manage these pressures, central banks and commercial banks have absorbed massive amounts of government debt, binding their stability to the fiscal health of the state itself. At the same time, households and corporations are carrying historically high levels of private debt. Housing markets inflated by years of easy credit now sit atop valuations that cannot be justified by incomes. Businesses reliant on low borrowing costs now face higher refinancing risks. Consumers, squeezed by inflation and stagnant wages, increasingly depend on credit to maintain their standard of living. In this environment, debt is no longer a tool. It becomes a structural dependency that expands faster than the capacity to repay it. The banking system sits at the center of this triangle. Banks hold government bonds as safe assets, even when rising yields erode their value. They extend credit to households whose repayment capacity is shrinking in real terms. They finance corporations whose profit margins are being compressed by global pressures. Every direction of exposure points to a source of fragility. And because all three sectors are interconnected, stress in one creates immediate strain in the others. This is where the true danger of stage 6 becomes impossible to ignore. A government facing fiscal strain is forced to issue more debt, which banks must absorb. Banks under pressure reduce lending, which weakens the private sector. A weakened private sector reduces tax revenues, further destabilizing public finances. The system begins rotating through these cycles more quickly, feeding on its own contradictions. Even small disturbances, shifts in rates, currency fluctuations, disruptions in trade, echo through all three domains simultaneously. What makes this moment especially severe is that traditional escape routes are no longer available. Governments cannot meaningfully reduce debt without triggering political and social crises. Corporations cannot deleverage without shrinking economic activity. Households cannot adjust without facing declines in living standards. Banks cannot unwind their exposures without revealing the depth of their vulnerabilities. Every path out of pressure leads to a different form of instability. And so the three pillars, public debt, private debt, and banking stability, move in lockstep, tightening the cycle and accelerating the conditions that define the next phase of the pattern. A phase where strain becomes visible not only in data, but in the daily experience of entire populations. As the pressures linking public debt, private debt, and banking fragility intensify, the system approaches a stage where the final warning signs begin to surface. These signals are usually subtle at first, appearing in areas only closely monitored by analysts, institutions, and industry insiders. But as stage 6 progresses into its late phase, the indicators grow clearer, more visible, and more difficult to dismiss. What once seemed like isolated fluctuations now forms a coherent pattern that aligns with every historical collapse of major financial systems. One of the earliest signs is the distortion of yield curves. In stable environments, yield curves reflect confidence in long-term growth. But when economies approach systemic fragility, the curves flatten or invert, indicating investors no longer trust the future to behave like the past. This has already occurred repeatedly in the United Kingdom, Germany, and Canada. The market is not simply forecasting slower growth. It is pricing in structural uncertainty, signaling that the financial architecture is losing its ability to project stability over time. Another telling indicator is the accelerated movement of capital away from traditional banking assets. Institutions begin shifting funds into ultra-safe holdings, not because they expect returns, but because they expect volatility. Corporations increase their cash positions. Wealth funds diversify more aggressively. Banks quietly increase their liquid reserves. These actions, taken together, reveal a growing awareness that the system is nearing a threshold where unpredictability becomes the defining characteristic of markets. At the same time, liquidity begins to behave in abnormal ways. Periods of calm are interrupted by sudden shortages, forcing central banks to intervene repeatedly. Market depth deteriorates, meaning even routine transactions start to create larger price movements. Instruments that were once considered highly stable, government bonds, blue-chip corporate debt, secured lending markets, begin showing signs of stress that reflect the mounting tension beneath the surface. The real economy starts sending warnings as well. Housing markets soften in unpredictable patterns. Certain industries face abrupt declines as financing tightens. Consumer confidence dips, even in periods of seemingly positive data. Governments respond with increasingly aggressive measures, subsidies, emergency programs, rapid policy shifts. But each intervention compresses the window of time before the next distortion appears, creating a rhythm that becomes familiar to anyone observing closely. All of these signals converge into a single uncomfortable reality. The foundations supporting the financial system are no longer behaving normally. They respond more erratically, recover more slowly, and trigger consequences that spread faster through interconnected institutions. This is the stage where internal reports become more cautious, where policymakers speak in more measured tones, where central bankers avoid definitive statements about stability. The language changes because the environment has changed. The system is preparing, not consciously, but structurally, for stage 7. And while the public may not yet see the full scope of these developments, history shows that once these signals emerge simultaneously, the final phase is no longer theoretical. It is forming quietly, waiting for the catalyst that will reveal what has been building all along. As the late signals of stage 6 intensify and the system moves toward its breaking point, the final transition begins forming in silence. Collapses rarely start with dramatic announcements or obvious shocks. Instead, they emerge from the slow accumulation of pressures that no longer have anywhere to go. For banking systems in the United Kingdom, Germany, and Canada, this moment arrives when liquidity, confidence, and structural integrity converge into a narrow window where even minor disruptions can reshape the entire landscape. Stage 7 is not a single event. It is the point where the system's internal contradictions finally override its capacity to stabilize itself. And when this transition begins, it often looks like a temporary disturbance, a sudden liquidity shortage, an unexpected government intervention, a rapid spike in bond yields. Banks reassure the public, regulators insist conditions are manageable, and markets attempt to regain balance. But beneath these surface reactions, the architecture has already shifted. Institutions that once relied on depth and resilience now operate in an environment where every movement generates outsized consequences. Because stage 7 is not defined by the collapse itself, but by the irreversible slide toward it, a slide that accelerates with each attempt to restore normality. During this phase, the lines between sectors blur even more. Governments face rising borrowing costs at the exact moment banks become less capable of absorbing new debt. Corporations reduce activity under pressure from tightening credit, weakening tax revenues, and increasing fiscal strain. Households react to rising uncertainty by pulling back on consumption and increasing precautionary savings, slowing economic momentum further. The system begins feeding on its own contractions. Every adjustment amplifies another. Every effort to restore balance shifts stress elsewhere. And each movement exposes a deeper fragility that can no longer be contained by traditional interventions. What makes this stage so historically dangerous is that confidence, once the invisible foundation of banking stability, no longer behaves predictably. Assurances lose effectiveness. Policy announcements trigger volatility instead of calm. Market reactions appear disconnected from fundamentals. It becomes clear that the system is no longer responding to guidance, but to pressure. And once this dynamic takes hold, the path forward narrows, not toward immediate collapse, but toward a structural transformation, where the institutions that existed at the beginning of the cycle will not be the same ones that emerge at the end. This is the moment when individuals, governments, and entire financial systems must confront the reality of how fragile stability becomes when stretched across decades of leverage, dependency, and expanding obligations. And understanding this pattern, seeing how it forms, how it tightens, and how it finally turns, is what allows us to navigate the transition with clarity rather than surprise. It is not the end of the story, but the point where everything we have explored so far becomes visible in real time. If you made it this far, leave a comment saying something like, "I stayed with you until the end, so I know you followed the full journey." And if this content has helped you understand the magnitude of what is unfolding, consider subscribing so you don't lose the next chapters of this series. A like also helps this message reach more people who need this perspective. And if you want to keep expanding your understanding, there's another video right here that continues this discussion from a different angle. Click and keep going with me.